Hey everyone, welcome back to the channel. Today we're diving into something that affects every single one of us, banks. Ever wondered how they actually work? I mean, you deposit your money and somehow they make a profit while lending it out to others. But how? Well, I've got this awesome visual guide that breaks it all down in a super simple way. We're going to talk about the core mechanics of banking, the famous spread, and 4 key banking factors that keep the system running. Stick around because by the end of this video, you'll understand banking like a pro. Let's jump in. Okay, let's start with the basics of how banks operate. Picture this. You've got some extra cash and you decide to deposit it into your bank account. In our visual guide, these folks on the left are the depositors. That's you and me. We give our money to the bank, and in return, the bank pays us a little something called interest. Here, the bank is paying depositors 4% interest. So if you deposit $1,000, you'd earn $40 in a year. Not bad, right? Now, what does the bank do with your money? They don't just let it sit there collecting dust. The bank takes your deposit and lends it out to other people. These guys on the right are the borrowers. Maybe someone needs a loan to buy a car, start a business, or get a mortgage. The bank loans them the money, but here's the kicker. They charge the borrowers a higher interest rate. In this case, it's 10%. So if the borrower takes a $1,000 loan, they'll have to pay back $1,100 after a year. Now let's do some quick math. The bank is paying you, the depositor, 4% interest, but they're charging the borrower 10%. That difference, 10% minus 4%, is 6%. And that, my friends, is called the spread. This 6% spread is how banks make their profit. It's the core of their business model. They take your money, lend it out at a higher rate, and keep the difference. Pretty smart, huh? But hold on, it's not that simple. There are some rules and factors that banks have to follow to keep this whole system running smoothly. Let's dive into those next. Okay, so banks can't just take all your deposits and lend them out willy-nilly. There are some important regulations they have to follow, and our visual guide breaks them down into 4 key factors. Let's start with the first 2. First up, we've got the CRR, that stands for cash reserve ratio. This is the percentage of deposits that banks must keep as cash in their vaults or with the central bank. Think of it like a safety net. If everyone suddenly shows up at the bank wanting their money back, the bank needs to have some cash on hand to give them. For example, if the CRR is 10% and the bank has $100 million in deposits, they have to keep $10 million as cash. They can only lend out the remaining $90 million. Next, we've got the SLR, statutory liquidity ratio. This is the percentage of deposits that banks must invest in safe, government-approved securities, like bonds. This is another way to make sure banks don't take too many risks with your money. Let's say the SLR is 20%. Using that same $100 million in deposits, the bank would need to invest $20 million in bonds. So between the CRR and SLR, the bank might have to set aside a good chunk of your deposits before they can even think about lending the rest out. Let's break it down with some numbers. If the CRR is 10% and the SLR is 20%, that's 30% of the deposits that the bank can't touch for lending. So out of $100 million in deposits, $30 million is locked up, and they can only lend out $70 million. These rules are set by the central bank, like the Federal Reserve in the US, or the Reserve Bank of India, to make sure banks stay stable and don't overlend. Pretty cool, right? But we're not done yet. Let's look at the other 2 factors. All right, let's move on to the third factor, the repo rate. This is the rate at which banks can borrow money from the central bank. Sometimes banks might not have enough cash to meet their needs. Maybe they've lent out too much, or they need to cover some unexpected withdrawals. In those cases, they can borrow from the central bank, but they have to pay interest on that loan, and that interest rate is called the repo rate. If the repo rate is high, borrowing becomes expensive for banks, so they might lend less to borrowers. If it's low, they can borrow more cheaply and lend more. It's a way for the central bank to control how much money is flowing through the economy. And finally, we've got the reverse repo rate. This is the rate at which banks can lend money to the central bank. Yep, you heard that right. Sometimes banks have extra cash they don't need, and they can park it with the central bank to earn a little interest. The reverse repo rate is usually lower than the repo rate, but it's another tool the central bank uses to manage the money supply. If the reverse repo rate is high, banks might be more likely to park their money with the central bank instead of lending it out. If it's low, they'll probably lend more to borrowers instead. It's all about balance. So let's recap these 4 factors. The CRR and SLR force banks to keep some of your deposits as cash or in safe investments, while the repo rate and reverse repo rate control how much banks can borrow or lend with the central bank. Together, these factors make sure the banking system doesn't go off the rails. No pun intended. But let's tie it all together and see how this affects you, the depositor, and the economy as a whole. All right, let's bring it all together. You deposit your money at 4% interest, and the bank lends it out at 10%, making a 6% spread. But they can't lend out all of your money because of the CRR and SLR. They have to keep some as cash and invest some in bonds. If they need more cash, they can borrow from the central bank at the repo rate. And if they have extra cash, they can lend it to the central bank at the reverse repo rate. All of these factors work together to keep the banking system stable and the economy humming along. Now, why does this matter to you? Well, these factors affect how much interest you earn on your savings and how much you pay on your loans. If the central bank raises the repo rate, for example, banks might raise the interest rates on loans, making it more expensive for you to borrow. But they might also raise the interest they pay on deposits, so you'd earn more on your savings. It's all connected, and that 6% spread, that's what keeps the bank in business. But it's also influenced by these four factors. Pretty fascinating, right? And there you have it, a simple breakdown of how banks work. From deposits to loans, the spread, and those four key banking factors, you now know the basics of what keeps the banking world spinning. If you found this video helpful, don't forget to give it a thumbs up, hit that subscribe button, and ring the bell so you never miss an update. Let me know in the comments what's one thing you learned about banks today that surprised you. And if you want to dive deeper into personal finance or economics, check out this video right here, point to the screen. Thanks for watching, and I'll see you in the next one.